Hello and welcome to a brief overview of some of the credits that are available to individual taxpayers. Credits are an important part of basic tax planning strategy. One or some of the ways that you reduce your tax obligation is to look for excluded income or income that's not included in the tax calculation, deductions to arrive at AGI or deductions above the line, and then itemized deductions or deductions below the line, and then credits. And the thing about credits is they are a dollar for dollar reduction in your tax obligation. So in that way, they are better than deductions. A $1,000 deduction, if you're in a 15% tax bracket, will save you $150, whereas a $1,000 credit will save you $1,000. So they tend to be a bit juicier, and so we want to at least be aware of some of the common credits that a person might look for. First up here is the American Opportunity Credit, which is a credit for going to school more than half time, or it's usually often thought of as the full-time school credit. It is available for the first 4 years of school. It maxes out at $2,500. It basically covers the first 100% of the first $2,000 of your qualified higher educational expenses. And qualified higher educational expenses tend to be tuition and fees, books and supplies. So if it's required for your program, then quite likely it falls under qualified higher educational expenses. So we're going to get a credit for 100% of the first $2,000 and then 25% of the next $2,000 for a maximum credit of $2,500. Not too long ago, it became 40% refundable. Many students don't have much in the way of a tax obligation. For example, imagine if you just didn't have any income because you were going to school full time. You wouldn't owe taxes, so a credit when you don't owe taxes isn't very beneficial. So now they've made it 40% refundable, which means it can drive you below zero tax and actually create a subsidy that will come your direction. We do have to sort of look at this credit in relationship to other educational benefits that you may be taking advantage of in the tax code. So we have to look at this credit in relationship to the lifetime learning credit, to the tuition and fees deduction above the line, and then also there are some exclusions for savings bond interest for education and whatnot. And so these educational benefits in the tax code have to be coordinated with each other, and you can't double dip on them. So most of the time people do take this credit as long as they're eligible to, because this is the most beneficial educational credit. Now I will say that it follows the dependency exemption. So what that means is if the student is a dependent of their parent, then the credit can go to their parent, which is sometimes more beneficial because the parent may have more income and more tax obligation. But if the student is independent or is claiming their own dependency on their tax, then the credit would follow the student. And so there's an opportunity to do a little tax planning there also. The next credit that I would like to discuss is in the same area. It's the lifetime learning credit. And this is not quite as juicy, but it is a 20% credit for qualified higher educational expenses up to $10,000 per year. So the credit maxes out at $2,000 per year, and you don't get there as fast because it's not the 100% of the first 2,000; it's 20%. But this one's not limited to the early part of your education, and it is also it does not require that you have or that you go to school more than half time. So this is a great credit if you're furthering your education, doing some continuing education, if you're going on to graduate school, those types of spaces. So it sort of fills in some of the gaps when the American Opportunity Credit doesn't work. So the next credit is the Child Independent Care Credit. This credit was designed to try to help working people afford childcare, because childcare has become very expensive. It's not even highly accessible in some areas because there's so few providers. So that's what this credit is for. And so the first thing there is you ought to look at the second bullet. It's so people can work, or if you're going to school, that's acceptable, but it's not so that you can have somebody watch the kids just so you can have some time away from them. And so there has to be this component that that it's helping a parent provide access to work. So it's for dependents under the age of 13, the thought being that once they get older than that, that they're able to self-supervise. Anybody who's ever had teenagers knows that they're not capable of self-supervision, but apparently the tax code doesn't know that. It's limited to $3,000 in expenses per dependent for a total of $6,000. So if you have 4 or 5 kids under the age of 13, then you're going to be capped out at the $6,000. And that's eligible expenses. That's not necessarily the size of the credit. You can't pay it to another dependent, but it can be paid to a family member. So you can pay your aunt to watch the kids while you're working. And then what happens here is, depending upon your adjusted gross income, we look at a table, and depending upon what your adjusted gross income level is, the credit runs from 20 to 35% of the $6,000 of qualified expenses. And so I won't, I didn't provide you a picture of that table here, but you can reference a textbook or reference publication 17. That table is indexed for inflation, so it does move around a little bit each year as it's adjusted. There is a small credit for the elderly or the permanently disabled. Honestly, it's not a credit that I see come into play a lot because it is, you have to have a fairly low income. So I just wanted to put this on your radar as one of the credits that is available. Now, the child tax credit, this is a more common credit. It's $1,000 per qualifying child. I will point out that it under the new tax law that was passed in 2017, that had some minor effects in 2017 but will have major effects on 2018 tax returns, this credit is scheduled to double. At the time of this recording, there's some question about whether or not it will be subject to phase outs or not. That seems to be unclear in the legislation. The prior credit for $1,000 was subject to phase out, and so if your AGI became high enough, this credit would be whittled away until it sort of disappeared on you. There just isn't a lot of guidance on the new tax law yet. So you have to be under the age of 17 or under the age of, you have to be under the age of 17. You can't provide more than half of your own support. They have to have lived with you for more than half the year. The way I think about this is these are minor children that are in your house or in your household because they are they're still young. It is often a big surprise or a bite to taxpayers when that high school student turns 17 and it's like, ooh, we just lost that $1,000 credit, because you can become sort of accustomed to having that on your tax return. There is a way that if you are unable to use this credit because you have enough other deductions that you do not have any tax obligation, then a portion of it can become part of the additional child tax credit and can become refunding. But there's interaction there with some other things that are going on, and so that's an issue that you have to look at if a person's tax obligation becomes zero. Here's an important credit, the earned income credit. This is also a refundable credit. So now this is our second refundable credit. We have a partial refundability for the American Opportunity Credit, and then the Earned Income Credit is refundable. And what we mean when we say refundable is it drives your tax obligation or your effective tax rate below zero and actually puts extra money in the pockets of recipients. And so imagine kind of a bell-shaped curve. For those of you that aren't familiar with what that looks like, Google that real quick. It's just sort of the normal distributions. It's a statistical term, but imagine a bell-shaped curve with very moderate income, and as your income goes up to a certain level, this credit rises, and as you pass the average or the center of that curve and your income starts to continue above it, then that credit declines. That's how this credit behaves. It's an incentive for work, and it's a credit for low-income earners to support them working, and the credit sort of goes up and supplements their income, and then once they start to become more moderate wage earners, then the income starts to decline. But it's not a cliff where it just like once you pass the threshold it's all gone. It declines kind of in a similar way that it rose, so that it doesn't create disincentives for work. In order to qualify, you have to have you can't have significant investment income. So you can't have income from rental property or income from a stock portfolio or things like that. I mean, you can have minor amounts, but they have to be below the limit. Because this is a refunding credit and it does put extra money in people's pockets, there is a potential for abuse, and so it's subject to some fairly significant due diligence requirements where you have to sort of double check to make sure that people are eligible, and if you're found to be abusing this credit, then you can lose your ability to take advantage of it in the future. I normally think of this credit as, in my mind, as a low-wage earning single-parent credit, but it isn't always that case. You can not have any children and still qualify for this credit. It's not as juicy in terms of dollar amounts, but a single person who's working for fairly low wages with no kids may be eligible for a credit. You can also qualify for it in a married filing joint situation, although many times if both parents are working, then they get beyond the thresholds and it's not as advantageous. So generally, I think of the head of household filer, single parent with maybe one or two kids. They're struggling, to work and earn a decent wage. Of course, they have, maybe potentially high childcare costs. And so this credit can kick into play in that situation, and it can be quite sizable. It's not uncommon for it to reach, the $3,000 to $4,000 ranges. You will find tables in the back of your book that will show you the earned income credit based on the qualified earned income, and you should kind of scroll through that table and look at it and watch the credit rise, and then you'll see for a period of time that it's kind of tapped out or capped out at a certain amount, and it kind of is flat for a little while, and then it starts to decline. And I encourage you to look at those tables. Important credit, a fun economic or policy debate or discussion to have with people, which we won't have here, but is whether or not it is better to help people who really need help with a targeted tax credit, or whether or not it is better to raise the overall minimum wage to try to help people at the bottom of the income brackets. And of course, the answer there depends upon your view of economics and your view of human behavior and a variety of other factors. So I encourage you to sit down and have that debate with your friends. They'll really think that you're uncool. So the retirement savings contribution credit. This was a credit developed to try to encourage retirement savings. There was a study back in, I think it may have been in the mid to late 90s, that recognized that a whole bunch of people were not saving adequately for retirement. And in particular, there was a lot of concern that the baby boomers, who were a very large chunk of the population, were all going to retire together. And when they did, that there would be a lot of strains on the system because they simply hadn't saved an adequate amount. And so we have credits for up to $1,000. You can only consider $2,000 worth of contributions to your IRA or your retirement plan. But on that $2,000, then you could get a credit as high as 50%, which would be a $1,000 credit, 20%, which would be $400, and then 10%, which would be $200. And the size of the credit is based on your income. The lower your income, the higher the credit. And this is an attempt to sort of help encourage or incentivize people saving for their retirement. From a practical standpoint, this is a difficult credit. People who meet the income requirements of the credit generally don't have a lot of excess income that they can devote to savings because they simply do not have the resources. One place where I've seen this come into play and can be beneficial, if you have a very young wage earner that would, because they're maybe fresh out of high school or fresh out of college, or maybe they're working part-time while they're in college, and so they would have the income requirements, but they don't have the savings ability. Sometimes a grandparent or a parent can help make an IRA contribution to help capture the credit. So sometimes there can be some family tax planning opportunities here. Other times, you try to do what you can to take advantage of this credit, but it's again, it's kind of difficult because the people who qualify for the credit are generally, they need their resources for other purposes. So here's just a couple of other credits. I'll just mention a few other credits here. There's not a need for us to look at them in detail, but there are credits for a whole variety of things. We have had credits in the past for hybrid vehicles. We've had credits in the past for electric vehicles. There is a energy credit now for still for solar panels and biomass fuel stoves and a variety of energy efficient items. Those are generally referred to as the non-business energy credits. There is a fairly significant sized credit for qualified adoptions. And so if you are working with clients, or you yourself are in the situation where you might be able to be involved in an adoption proceeding or process, you should become familiar with those. They're quite significant in size. There are credits being added and subtracted, fairly regularly to the tax code. Again, to try to create incentives to encourage people to do things that the government feels to be in society's best interest. And so you should watch for these to develop and then also to go away over time, depending upon where we're at with the tax code at that particular moment. So thanks for dropping in for this brief discussion of some of the credits. I encourage you to do a little bit more research, look a little bit at some of the, with all of the credits, I would stay kind of focused on the bullets, on the big key issues. What is this credit designed for? What's the purpose of it? What are some of the key things associated with it? The details is something that you can always look up or go back to when you need it, because you can. The main thing is like, well, who's eligible for this credit and when might it apply, so that you know when. Oh, I should go look that up because this may be the situation where a person has a refundable additional child tax credit, for example. So resources are our friends, and so we don't have to have all of this at the top of our mind. We just have to have a broad, general working understanding of how it all fits together. Thanks again for joining. Take care. Bye.